But keeping it with the earnings, heavyweights HDFC Bank and ICICI Bank, they posted better than expected Q4 numbers with margin expansion and asset quality improvement along with lower slippages and credit costs. Now, both the banks gave stable outlook, with ICICI saying that the retail stress has bottomed out and HDFC aiming for CASA gains and a lower CD ratio ahead. Gaurav joins in with a comprehensive picture.
Well, yes, when we talk about HDFC Bank and ICICI Bank, both banks reported very good set of numbers. In fact, when we look at profitability, both the banks reported above estimated profitability growth for Q4 FY25. But there were other highlights from the quarter. So first, let's talk about net interest margins. Now, both the bank have actually shown some kind of improvement in net interest margins, whereas the street is expecting net interest margins to remain stable or decline a little bit. And when we talk about this gain, it is not just one-off gain. The banks has said that it is actually something that can be factored in even from here on. So first, let's talk about when we talk about HDFC Bank, we have seen 3 basis point of gain in net interest margins, which they have contributed to the cut in CRR ratio. On the other hand, when we talk about ICICI Bank, a 16 basis point of improvement in net interest margin, and bank has clearly stated that it is not actually a one-off thing. It is a combination of multiple things which has actually led to the net interest margins of 4.41. Although the bank has said that from here on, on the long-term basis, 4.3% of FY25 is something that we can look as a representative for the bank, but definitely a very positive thing in fourth quarter. Second is that when we talk about asset quality, both the bank have shown some kind of improvement in asset quality. In fact, when we talk about net NPAs, they have gone down almost by 3 basis points for both the banks. In fact, when we talk about HDFC Bank, we have already seen slippage ratio at 1.2%, which is actually lowest among the peers when we compare it with the large banks so far. Other than that, when we talk about ICICI Bank, there also we saw gross NPAs going down almost by 20 basis points because the bank actually sold one of their portfolios worth 2,700 crore rupees. When we talk about loan and deposit growth, there also we saw very good set of numbers. In fact, when we talk about ICICI Bank, we saw loan book growth was actually a little less than what the street is expecting. But from here on, what bank is saying is that the personal loan and credit card segment has actually, the growth there has bottomed out. And from here on, bank will continue to grow at a pace which will be faster than the system. On the other hand, when we talk about HDFC Bank, we already knew that in FY26, HDFC Bank wanted to grow at the system level space, and they have continued to believe that as well. In fact, what they have also said is that the CD ratio will come down to around 85 to 90% gradually. So definitely another key trigger here. And lastly, when we talk about way ahead, there also we are seeing some kind of positive triggers coming up from the commentary from banks. So when we talk about ICICI Bank, although both the banks have agreed that the rate cut impact is going to be seen in Q1 FY26, but the increase in CASA and deposit growth is something to be watched out for, and that is the reason why they believe that the impact on the net interest margins will be limited. So definitely, brokerages have also upgraded the target price, and on back of this, we will also be watching out on how the stock will perform. But as of now, Q4 was a very strong set of numbers for both the banks.
All right, strong set of numbers coming in for ICICI and HDFC.